Did you know that the Federal Reserve raised interest rates to their highest level in over 22 years? Inflation is now so high that it's starting to eat into people's wages. The question is, why? In this video, we'll be cracking the case of those sneaky critical changes and their impact on the global economic landscape. To begin with, what exactly is inflation? Inflation means that the prices of goods and services go up over time, so your money doesn't buy as much as it used to. Imagine that you could buy a cup of coffee for 25 cents in 1970, but it would cost you $1.59 in 2019. So with $5 in 2019, you could only buy about 3 cups of coffee, while in 1970 you could buy 20 cups. That's how inflation works, and it affects not just one thing, but a country's whole economy. It's like inflation took a comedy class and mastered the art of surprise pricing. There are mainly 2 causes or types of inflation. Number 1, demand pull inflation occurs when demand exceeds supply. The COVID-19 epidemic caused surprisingly high demand for new vehicles, but a semiconductor scarcity made it difficult for the automotive industry to supply that demand, raising new and used car costs. Basically, demand was pulling inflation strings, but supply was playing hide and seek. Number 2, cost push inflation is when prices go up because the costs of making things and services are going up. During the pandemic, there were changes in demand, buying habits, and production costs, which made prices go up. We all know about that, don't we? Now here's an interesting fact. Inflation in the United States shot up 7.5% in January 2022, which was the highest amount since February 1982. This rise was caused by high energy prices, a lack of workers, and problems with the supply chain. A comparison that's often made is to the post-World War II era, when double-digit inflation was a big issue due to price controls, supply problems, and intense demand. Can you believe it even peaked at a staggering 20% in 1947? From the middle of the 1960s to the early 1980s, there was a time of inflation called the Great Inflation. In 1980, inflation went crazy high, reaching 14.8%. To deal with this, the Federal Reserve did something brave. It raised interest rates to almost 20%. Some experts say that monetary policy mistakes might have contributed to this inflation frenzy, not just high oil prices. Now the question is, why does the Fed raise the interest rate? When the economy is booming and getting too hot, things like inflation and asset bubbles can get out of control, which isn't good for economic stability. So that's when the Fed steps in to save the day, just like the hero of a film. They raise interest rates, specifically the federal funds rate, which is like a benchmark for how much banks charge each other for short-term loans. That is what happened here. With unanimous support, the Federal Open Market Committee raised the federal funds rate to a new target range of 5.25 to 5.5%. This was the start of its most aggressive effort to tighten money in decades. When the Fed increases the federal funds rate, they want to make borrowing more expensive for everyone, including businesses and regular people like us. It means loans, credit cards, and other stuff that involves borrowing money cost more. This slowdown in borrowing can help cool off the economy and keep things on a stable track. Let's take a look at how a 1% increase in the federal funds rate could affect a family shopping for a home. Imagine they were getting a $300,000 mortgage with an interest rate of 3.5%. With that rate, the total cost over 30 years would be around $485,000, and they'd pay almost $185,000 in interest alone. Their monthly payment would be about $1,340. Now, if the Fed had raised rates by 1% before they got the loan, and the interest rate offered by banks jumped to 4.5%, the total cost over the loan's life would go up to more than $547,000, with interest making up $247,000 of that. Their monthly payment would then be around $1,520. So when rates go up, people might hold off on buying a home or choose a smaller mortgage to keep their monthly payments in check. And it's not just home loans affected. Higher interest rates influence the stock market, credit cards, personal loans, student loans, car loans, and business loans too. It's like a big party where everyone is dancing the tango with interest rates. The stock market is like a drama queen when it comes to Fed rate hikes. You see, when the Fed decides to raise interest rates, it's like turning up the heat on the stock market stove. Companies have to pay more to run their businesses, which can mean less money coming in. So the prices of those stocks might go down and buyers might start to feel the pressure. Imagine you're at a party and suddenly the DJ plays a sad song. That's how investors react when the FOMC announces a rate hike. They quickly sell off stocks and run towards safer investments, like hiding under a blanket when things get tough. Also, when the Fed raises rates, existing bonds get a little grumpy. New bonds are on their way, offering higher interest rate payments to tempt investors. So the existing bonds feel left out, and their prices decline to make them more attractive. Oh, and credit cards. They're not big fans of rate hikes either. When the Fed raises rates, those credit card issuers follow suit and charge you more for carrying debt. It's like saying, hey, if you're going to borrow money, you better pay up. But hey, it's not all bad news. If you're a saver, you'll be doing a little happy dance. Higher interest rates mean banks will reward you with more dough for your savings account. You'll be earning more APYs and watching that money grow like magic. There is more. In general, when a country's interest rates are higher, its currency is likely to become more valuable. This increase in value happens because the higher interest rates attract more foreign investment, leading to a greater demand for that country's currency. But it might be tricky to know where to put your money in this time of rising prices and interest rates. DepositAccounts.com creator Ken Tuman says the world is becoming increasingly complex. While inflation has slowed recently, it's still causing concern, so the Federal Reserve plans to keep raising interest rates. Now, when it comes to savings accounts, you might think higher interest rates would mean better returns for you. But hold on. While the Fed's federal funds rate has hit a 22-year high, the interest rates on savings accounts haven't quite kept up with that excitement, according to Tuman. As of January 4th, the average interest rate for a high-yield savings account online was about 3.48%, although some smaller banks offered rates as high as 4%. Not bad at all, right? Tuman says you should stick with well-known banks instead of venturing into the wild world of fintech companies that work with banks to offer cash and savings accounts. But wait, there's more. Ever heard of CDs? It's definitely not the compact disc we used to play. In economics, CD means certificates of deposit, and they might have a little surprise for you. Tuman says it's a bit of a strange time in the CD world. You see, short-term CDs are actually offering higher rates than long-term ones. So if you're in for a short savings journey, a one-year CD might be more tempting than an online savings account in the coming year. Decisions. Now, if you're looking for a solution, Series 1 bonds might be your ticket. These bonds are like heroes fighting against inflation. With a nearly risk-free and inflation-protected feature, they've become quite popular among short-term savers. As of now, they're offering a mouth-watering 6.89% annual interest on new purchases through April. That's pretty impressive, right? But the rates might change in May based on inflation data. So if you're not planning to touch that money for a year, this could be a thrilling option to consider. Dealing with rising interest rates requires some careful handling. Just like navigating any other market conditions, the key is to find the right balance in your investments. According to Brian Stivers from Stivers Financial Services, things can get a little tricky during rising interest rates. Sometimes the stock and bond markets might surprise us with unexpected moves. It's like they're doing a magic trick that we didn't see coming. So in this wild market world, diversification is your secret weapon. Spread your investments wisely among stocks, bonds, and cash to protect yourselves from those rate roller coasters. Do you have any thoughts or questions about the factors behind these critical changes and their impact on the economy? Drop a comment below and let's keep the conversation going. And hey, if you enjoyed this video and want to stay up to date with all things financial, make sure to hit that subscribe button.